Hey everybody, it's Larry Berman here. Happy 2025 to everybody. You're started off with a little bit of volatility. Um, let's take a quick dive into the chart room and see what we learned while we were all off on vacation. After becoming a bit of a snowbird here, spending winters down in Florida, um, biggest focus really has been Canadian US dollar exchange rates. I can't tell you how many questions I got with the bad print that we saw a week ago on dollar CAD and everybody raging about, oh, I'm going to buy it, I'm going to buy it. Anyways, I was clear it was a bad print. Let's look at the chart here and see, because we've got this pennant slash flag type pattern, and typically these things are continuation patterns, and they're going to resolve where you get a move up, you get a consolidation, you get a move up, you get a consolidation, you get a move up, you get a consolidation. And so the bottom of the pattern here, here, like they didn't break. So a couple levels to watch on dollar CAD around 143.30. If we start breaking below that, it would imply a bit of a failure here and some sort of correction, maybe back to 140 or so, where the next sort of congestion is in terms of where there's some support. So that's something to watch for of the snowbirds. But the bigger message here, if we zoom out and we look at Canadian dollar, we've showed this chart many times. Currency started to float in the early 1970s after the gold standard fell. And if we look at how long the Canadian dollar has spent above 140, you can literally count it, in terms of years on one hand. You got a 5-year period in here where you were dealing with twin deficits and just everything that was really negative. Canadian dollar had to run significantly higher interest rates. And so that's very different than the environment we're in today, where the Canadian economy is structurally much weaker, and we've had to have much lower interest rates than in the US. So, that's a differentiating factor. The last few times and more recent times, like post GFC, Canadian dollar has been up here. These are quarterly bars. Hasn't stayed up here for more than a few months at a time. So it's possible we stay here for a few more months, possible until there's an election called. But really, where's fair value in the Canadian dollar? And, post GFC, for the most part, I would call it 125 to 133. So let's call that 80 cents to ballpark 75 cents. In that range is fair value. I think we'll get back to that once we get a change in leadership and government in Canada, and that doesn't play out until sometime in 2025, and hard to know when that is. The ball is in Jagmeet's court right now. I doubt Trudeau's ego will let him resign and step down and look for a new leader and call an election. Doesn't seem like the Trudeau that I've come to despise in the last decade that he's been, at the helm in Canada here. For what it's worth, you can look at, okay, Trudeau got into power, and what happened to the Canadian dollar ever since. So Canada's become an uninvestable place. One could argue that we would get stronger than that, but I think this period here where the Canadian dollar was, much above 85 cents was more of the anomaly. If you look at where has it spent the most of its time, in the last 40 years, and the answer is that range that I gave you, somewhere centered around, 80 cents and a little bit less. Okay, so that's the Canadian dollar story. Bigger story on the Treasury side. The U.S. Congress just got put into power. Mike Johnson got to be the leader at this point. Listened to his speech today, and the message there is pretty clear. in terms of them wanting to be fiscally prudent in order to get some of those votes that he needed to become speaker. I guess promises were made. So, but Trump's agenda is to spend $7.5 trillion on tax cuts and other things, supported by less regulation and a bunch of other things. I'm not sure we can do that. So 2025 will be a very, very interesting year. He's got a 2-year mandate with control of the Senate and Congress to get things done. So, working with the Doge, apparently that's a thing for Congress, and we'll see what Elon Musk's influence is, in 2025 as well. So does the pure technicals of this pattern suggest that in the first half of the year, the debt ceiling limit somewhere around middle of the year is where it's a must? Extraordinary measures kick in. There's a bunch of other things, but Congress kicked the can before the break, and that becomes an issue again in a few months. February 5th is the next quarterly refunding announcement. So you got a new Treasury Secretary who has spoken out against the policy of Yellen in terms of funding the deficit with way more bills than historically done. That's turned in terms of the government risk. So I think they we're likely to see that term out, but whether they do it now and blame it on the Dems or, so February 5th is a big day for the bond market. And so we could possibly see the long end drift up to there. That's a TLT around 85. We went out on Friday at 87 and change. For those of you who are worried about the economy, this is probably one of the best bets you can make in the next few months. So keep that on your radar for opportunity, buying U.S. long bond duration for perhaps a harder economic landing than the market's pricing in at the moment. If we look at the Santa Claus rally, again, Christmas Eve, 7 trading days, we have them lined out here. Nothing made anybody any money. So, you hear these things, oh, Santa Claus rally, it's all good. Started off okay for day one and then kind of went downhill. And yeah, we got a big rally on Friday to close the week, but still, whatever index you're looking at in the US, equal weight S&P, mid cap, small cap, NASDAQ, all negative Santa Claus rally results. So goes January, so goes the year. We'll see how it all plays out here, but the markets aren't cheap, folks. So earnings will matter. Does the bottom part of the market catch up to the large cap leadership, or does the large cap leadership catch down? Stay tuned for that eventual outcome. So when we look at the S&P and we look at the technicals, there's a line in the sand I think we need to be wary of. When we look at the post FOMC sell-off, we came down, we tested slightly below the gap, post-election gap. So election day, gap higher, test, successful, gap, rally, new high, failed new high, test of support. So this red trend line here projected out a month above 5,800. If it breaks, 200-day average comes into play, and we start talking about, not a great start to the year or a bit of a taking off of the froth, from approximately a high around 6,100 on the S&P late last year. You can see the number there, 6099.97, 10% correction, 600 S&P points. So tested the 200-day average, seems pretty likely some point in Q1. And better hope that holds. No reason it shouldn't, as long as the economy's ticking, Trump's getting stuff done. Lot to play out there. Anyways, Happy New Year, everyone. Hopefully, it's a very prosperous new year, but don't look for another 20% on the S&P 500 this year.